There we go. Okay. All right, Andy, take it away.
Great. Thanks, Kristen. And I appreciate the time to do this. As Kristen said, our company doesn't do commercial lending, so I'm not here as a promo to give you information and then hope to get some business. Well, I am hoping to get business. I'm hoping you like this so well that you'll throw me some of your, your residential buyers. And I'd love to work on those transactions. But yeah, I spent 20 plus years. In fact, I'm still doing it. I own a business that does commercial banking training all over the country, and I train for banks, little community banks, up to Wells Fargo and Capital One and some of the 10 biggest banks in the country. And as Kristen said, underwriting, I mean, all of you as realtors, don't you sometimes want to know what's going on in the head of these underwriters, right? If you could get into their brains and know what they're thinking, it sure would make our lives a lot easier. So those of you that are on this call or maybe listening to the recording in the future, I assume you have some interest maybe in doing some commercial deals. So I'm just going to try to bring, I've got maybe a half hour or so of information, and I'll be happy to take any questions. I'm certainly not, I don't know everything about this, but I spent enough time to at least give you a basic introduction to it, and hopefully it'll be helpful. Feel free to interrupt if you have questions. And I don't know if people want to chat. Kristen, you can monitor that, or just interrupt, whatever is comfortable for you. That might work better than waiting until the very end to take questions. So yeah, I'm with American Residential Lending, and we do a 1 to 4 family unit. So I said we don't do commercial, but if you have a duplex or a 4 unit, you're looking for financing, we can certainly do that too. Okay, Kristen, you want to go to that next slide? And I'll just cover what is on the agenda for today. And these are the 4 things I want to cover. I want to do a quick comparison between residential real estate and commercial real estate. There are some similarities, which I'll talk about, and then there's some really significant differences too. So we'll talk about that, give you a quick snapshot of some of the different types of commercial real estate that I suspect you're already familiar with. And then we'll talk about how lenders and how underwriters view commercial real estate as collateral. That's really important. And then if you want, at the end, I've got a little example I can walk you through it. The math might give some people a headache, but just for the fun of it, if you want, we'll go through a quick example of one of the ways to actually appraise commercial real estate properties. So there's our agenda. And with that, Kristen, if we can go to the next slide, we're going to talk about some of the similarities between residential and commercial. So can we flip forward, Kristen? I'm still seeing the same agenda slide. Kristen, can we go to the next one?
Sorry, I can see it on mine. I don't know why. I'm over here.
Oh, okay.
There we go.
It just updated. Okay. So now we got to go back one.
Is it showing like a there? Is that okay?
Yeah. So,
one more.
Yeah, one more. There we go. Yeah, there might have been a little delay there. Okay, so here are some similarities between residential real estate and commercial real estate. For one thing, they both have to be creditworthy, right? Or borrower if they're not creditworthy. And so what does that mean? In the residential world, as I'm sure you all know, it means things like what's their credit score? That's the first thing we check, right? The better the credit score, the more likely the underwriters are going to like it, because they're showing a history that as they borrowed money in the past, they've used it appropriately and paid it back. So credit score, debt to income ratios, what kind of assets they have, how much cash do they have on hand for down payment and for reserves and that kind of thing. That's the things we look at in the residential world. In the commercial world, it's a little different because we're looking at typically a company and whether they're going to repay, and companies don't have credit scores. You don't pull up something on a 400 to 800 scale. So there's a little bit more involved, and I'm not going to get into all that, but you look at a company's balance sheet, typically in their income statement, if it's an operating company, and you're looking at what kind of leverage and liquidity they have and what their cash flow looks like. And I'll get into a little bit later what we look for in commercial real estate. So that the first point is they have to be creditworthy. If they're not, then it's probably not a deal. Second similarity is that in both cases, the loans are secured by real property. And then the long useful life of an asset. I've got another slide on that later, and that seems obvious to you, but in the world of commercial banking and other types of commercial lending, some of the assets we take as collateral don't have a long useful life, and I'll talk about that in a second. And then the other similarity is that these can be owner occupied or non-owner occupied. So in the residential world, again, if you have a duplex or a fourplex, that's kind of non-owner occupied. Most of what I'm sure you do, most of what I do in residential lending is for owner occupied, where you have a person or a family that's moving into a home. In the commercial world, a lot of the time, probably the majority of the time, it's going to be non-owner occupied. Okay, so there's similarities. Let's go to the next slide then, and we'll talk about some of the differences. And this is where we may get into some stuff that you're not as familiar with. One of the big ones is that when we do loans on commercial real estate, there is no follow-up. On residential real estate, there's no follow-up or monitoring, right? When we make a loan to someone wants to buy a house, the underwriters will do their thing. They'll check their debt to income ratios and they'll check their credit score and all that. And once they give the approval, the loan is funded, the people buy the house, and typically you never talk to those people again, which from my background in commercial, that was crazy to me, that we would make a loan to someone and just kind of assume, well, they had a job at the time we made the offer, or the time we made the loan, and they had assets at the time we made the loan. So we're just going to assume for the next 30 years, we're never going to check on them. We're never going to ask for current tax returns. We're never going to ask for updated W-2s. We just assume. So that's a big difference. Whereas in the world of commercial, the loans are monitored. So if we do a loan on a commercial building, we're going to constantly be checking up on what's happening with the occupancy rates and what's going on in the market in that particular geography or in that type of property. So when we make a loan on the commercial side, I make the analogy, it's kind of like dating somebody, right? Or getting engaged. Once you make the loan, that's when you get married. And that's, for those of you that are married, right? That's when it starts. Okay, that's not the end of that's the end of the courtship, but that's the beginning of the long-term relationship. And we're going to keep communicating with them as time goes on. So that's a really, really big difference between residential and commercial.
Just one thing for the new agents, Keller Williams promotes, not for tax returns and stuff like that, but staying in touch with your clients after the transaction closes. So just for the new agents, make sure that you know that.
Yeah, thank you. And I mean, that's a good marketing tool, if nothing else, right? Because most people are going to buy another home later in their life. So you definitely want to stay in touch with them if for no other reason than that. But, from a financial standpoint, from the loan standpoint, from your point of view as a realtor, that's super important because of the relationship. The lender is never going to circle back with that person ever after they buy the home. So, okay, so here's some more differences. The amortization, or meaning the repayment schedule, is usually a little different. I suspect most of the folks that are buying your homes are going to be doing a 30-year fixed rate mortgage. In the world of commercial real estate, they usually like a little bit shorter amortizations. 20 to 25 years is a little bit more common. So you will see some 30 now and then, but at least in the time that I did it, 20 was a lot more common, 25 probably less common. The other really big thing, and I want you to think about this, is the term or the tenor. Sometimes you hear that word tenor, the term of the loan, meaning how long is it from now until when the loan matures. That's usually a lot shorter on commercial real estate properties than it is for residential. Now, for residential, the term is usually 15 or 30 years, right? So we'll say 30 years as an example. So the amortization is 30 years and the term is 30 years. So in your mind, you may have never even thought about there being a difference in those, but with commercial real estate, the amortization may be 20. In other words, we take the amount of money, we divide it up, you stretch it out over 20 years so that their payment is smaller. But usually the term of a commercial real estate loan is about 5 years. In other words, the loan matures. If we're doing the loan today, it matures 5 years from now, even though the payments are set up to go out over 20 years. So if you think about that for a second, why would lenders do that? We're telling the borrower 5 years from now, you're only going to have paid the loan off, maybe 10% of the principal paid down or less 5 years from now, but then you're going to have a big balloon payment and the loan's going to mature. So anybody want to take a guess as to why would we do that? That's different than residential.
I guess I don't understand the meaning.
Yeah, well, it's fair, because if you haven't done these, which you probably haven't on residential, it doesn't make any sense. And here's where I'm going with it, is if we do a 5-year maturity, what we're telling the borrower, let's say we lend someone money for a commercial office building and they've got a bunch of tenants in there. And at the time you make the loan, it's 100% occupied. So the rental income looks really good. And we feel very comfortable making that loan. Well, we are not comfortable saying, here's the money. Sure, hope everything goes well for 20 years and hope you keep making the payments. We're going to tell them 5 years from now, we need to come back and you need to pay off the balance of the loan. Now, most borrowers are going to say, that's crazy. If I'm borrowing $1 million to buy this building, I'm not going to have $920,000 in cash 5 years from now. So what do you suppose we, as the lenders, what do you suppose we would do, assuming everything's going well? What would we do 5 years from now when that balloon payment comes up?
Refinance, or is that?
Exactly right. We'd refi. We'd just say, okay, everything's going well. We'll just push the maturity date out another 5 years. We'll refinance it and just keep making the same payments, type of thing. Where the rub comes in is if things aren't going well, and of all their tenants, instead of having 100% occupancy, now it's down to 40% occupancy because something happened in the building or in that neighborhood or whatever. This gives us as a lender, and this is the way the underwriters are thinking. They're thinking we want to be able to have the power to come back every 5 years, come back to the negotiating table. And if things aren't going well, we say, hey, you need to pay this off. And they go, I can't. Why don't you refinance it? And we say, no, we're not interested in refinancing. You need to go find some other lender that'll do that for you. So it allows us to get out from under in a shorter period of time, taking it in 5-year chunks as opposed to taking it in 3. And again, you never see that in the residential world, which is why I'm not surprised no one really had an answer to why we would do that, because that's just not done in the residential world. But in commercial, because so much can change in a few year period of time, we want to give ourselves that. So there's a difference in the commercial real estate world between the term of the loan and the amortization. So that's a new concept. Does that make sense to everybody, or questions on that? Okay, good. Let's go to the next slide then, and we'll talk about a couple other differences between residential and commercial. So maybe you've never thought about this. As an underwriter and all the training I do, I teach people to think about repayment sources. Where is the borrower going to get the money to repay the loan? And when I was new in banking, I just thought, who cares? As long as they have money, I don't care where they're getting it from. Well, underwriters think about this because they're always measuring risk. And if they're going to lend money, there's always a risk that the borrower is going to default and not pay the money back. So they're thinking, what could go wrong? Underwriters are kind of skeptics, okay? They have their skeptic hat on, so you need to know that. They want to make loans, but they're always thinking, what could go wrong here? And especially in the commercial world, because you got a lot more zeros sometimes on a $10 million loan than you do on a $100,000 residential loan. So we want to think about what's the primary, here's some terminology, some primary and secondary sources of repayment. The primary source of repayment just means, how are we probably expecting they're going to pay us back? And for residential, of course, it's just the borrower's income. I mean, unless they have $1 million trust fund or something, but in most cases, they've got a little bit of cash put away, but we're counting on them being a working person and a person who honors their agreements. And when they borrow money, they're going to have cash flow coming in from a job or a business they own to make their payments. So that's the primary source of repayment. Anybody want to take a stab? What's the secondary source of repayment? The secondary is the backup source of repayment. So in case they lose their job and everything dries up, what's the underwriter thinking? What's the next best way that we're going to get paid back?
Take collateral.
Exactly right, the collateral. So collateral is almost always, in residential or commercial, is almost always our secondary or backup source of repayment. None of us want that, right? But if something happens, we will. That's why we take a lien. That's why we will go in and foreclose on the property, hopefully sell it to someone else and get the cash back till the loan's paid off. So in the commercial world, the primary source of repayment is something different. It's not a person out there working. It's usually rental payments from some tenants, whether it's a retail space, an office space, apartments, or whatever. You're counting on the tenants that are in there. You're counting on the occupancy rate staying high, and you're counting on those people making payments. So it's still cash flow coming in, but it's a totally different source of repayment. And that's an important thing to be aware of, again, when we're contrasting residential and commercial. Okay, questions on that? Okay. So Kristen, if you want to just, these next few slides, I just put 3 pictures in here, and we're going to come back to this office one, but these are just 3 very common types of commercial real estate. You have the office, this one's retail. And in retail, there's always, if you flip back just a second to that retail one, There's usually what's called an anchor in a retail strip center or in a big shopping mall. So the anchor might be your Walmart or some big box store that a lot of people are coming to that geography, to that shopping center primarily for that, to come to that store. It's an anchor. And so then those little stores that are on all sides of it, people say, hey, while we're here, oh, well, I didn't know there was a Verizon store. I didn't know there was a boutique here, or whatever. And they'll go to those other stores. But a lot of the foot traffic is generated by the anchor store. So commercial real estate underwriters are always thinking when it's a retail space, they're thinking, is there an anchor? And if so, what is it? And they want to know, like H.H. Gregg, might have been an anchor 5 years ago, and they're gone. And with COVID and all these things, some of these stores that everyone thought certainly they'll always do fine, now they're having a lot of financial problems. And so we want to analyze how that anchor typically wouldn't go in and analyze the financials of each of the little tenants in a retail space, but they will look at who the anchor is. Okay, and then the other one on the next slide is just apartments, and we're all familiar with that. So there's 3 different kinds, but they all share in common that we're looking at how occupied are they, what are the rental rates, how much income is coming in from the tenants, because that's going to be our primary source of repayment. Okay, if we can go to the next slide, I want to talk a bit about commercial real estate as collateral. So again, we're talking now about the secondary, the backup source of repayment. You're all familiar with this because this is why we go through all the legal paperwork of taking homes as collateral when you do your residential transactions. So the first thing is there's a long useful life of the asset. And I mentioned that as a similarity, whether you're doing a single family home or an 8-unit office space. In my experience in commercial banking, we take all kinds of things as collateral. If we're banking a pizza shop, and we've done this, shame on us. It never works out well. But if we're banking a pizza shop, the inventory is cheese and tomato sauce, right? And empty pizza boxes with the name of Joe's Pizza on it. That inventory turns really, really quickly. And in some ways, that's collateral that's a little bit difficult to get a sense of what it's worth. Sometimes we'll also lend money on the equipment, the pizza ovens. Okay, if it's a Chipotle, you've got beef and cheese and guacamole, and then you've got your grills back there that they're chopping up the stuff on. And equipment lasts for 3 to 5 years, but the dirt and buildings last the longest. And so that's why we tend to like that as collateral. It's fixed in one location. It can't go anywhere. And you go, duh, but I'm telling you, lenders lend money on things that can disappear. But things that are not real property, that aren't dirt and buildings. When I was in banking, we banked a retail jewelry store, and we ended up losing many millions of dollars because our inventory left the store in a briefcase. I won't tell you whose briefcase, but it left the store, and then there was a supposed robbery that happened, and it's a long story, but we lost over $1 million of inventory because it got carried away by one person in their briefcase. So we don't have to worry about that with real estate. We like the fact that it's fixed. It's attached to the dirt. Another company we banked rented cranes, commercial cranes for construction jobs. So imagine if we had to go and seize that collateral. It's not like going to a house, getting the sheriff to kick people out and foreclosing. There's cranes on construction sites all over the state and all over the Midwest. And how do you get those back? Even if you have legal right to them, that's a more difficult thing. So just trying to, again, get you to think in your head what's going through the underwriters' minds as they think about taking commercial real estate as collateral. Is this is something we like. It's all right there in one place, and it's got a long, useful life. If we flip to the next slide, there is a possibility, at least, of fluctuation in market value. So this is true of residential as well, but it can be a little more severe on the commercial side. And that's why we're constantly reassessing. And again, on your transactions, the homes that you sell are appraised, right? The buyer and the seller want to know what the home is worth. In the commercial world, we'll appraise it up front, but then we'll go back and reappraise every so often, might be every 2 years, every 5 years, because market conditions are changing. Things in a certain geography might be changing. Economic cycles are happening. If I can interject one quick story just to give a sense, I'm sure you've all seen in your careers values of properties fluctuating a little bit, right? Especially after 08, 09, we saw some of that. So this story takes place 2007 to 2009. Okay, so you remember what was happening there. 2007, everything's booming. Then 2008, everything kind of crashes. 2009, real estate's, in a bad way. Same thing happened in commercial. There was a property at the bank I worked for in a state north of here in Detroit, actually. And if you know anything about the economy in Detroit, heavily tied to automotive industry, obviously. So there was a site up there that was going to be developed with retail, commercial, I forget how many acres it was, but it was appraised before they ever did the work. It was appraised. The final, to be finished value was $30 million for this property. And we were asked to do some financing for it. 30 million. Okay. So write that number down. Then 2008, and I don't remember the exact time frames, but a few months later, after everything crashed, we had it reappraised, and I hadn't even broken ground yet. Okay, but this site that they had projected, they had drawings and architecture and all that of what the site was going to look like. The appraisal went from 30 million to 22 million. So how are you feeling now if you're the lender and you thought this thing was going to be worth 30? It just dropped $8 million in value. Nothing's even happened, but things are happening. Nothing's happened on the dirt, but things are happening economically in the country, and specifically in Detroit, where the economy, Detroit was not a good economic place to be doing business at that time. Well, I'll make a long story short. The value went from 22. We appraised it, I think 4 months later, it went from 22 to 7 million. And then 6 months later, we had it appraised again. Final appraisal value, $2 million. So it went from 30 million to 2 million. So when I say, now that's the most extreme story I've ever seen. But when I say there's fluctuation in market value, if a home goes from being worth 150 to 125, that's really devastating to some people. But in most cases, things can be worked out. When a property goes from 30 million to 2 million, that's pretty hard. That's pretty hard to deal with. So the owners had to get in and kick in some cash. Long, terrible story. But just to say, in the world of commercial real estate, again, there's more zeros. There's a risk of greater loss. So we've got to be more intentional about going out and reassessing and reevaluating. I put the terms valuations and appraisals because appraisals are more formal. They're done on larger dollar amounts. Some smaller properties that are maybe a couple 100,000-ish, they'll just do what's called a valuation, which could be anything from just a drive-by, take some pictures, look at some comps and whatever, but it's typically not as thorough as a full-blown appraisal. Okay. I want to talk about some methods to appraise, but before that, I'll stop. I'm throwing a lot at you. Does anyone have questions on anything we've talked about so far? Okay.
I have a ton, but I'll wait till the end.
Okay. So let's just talk about this, and then it looks like we've got a little time. I'll go through a quick example, but here are the three main ways that we appraise commercial real estate. And you all are very familiar with residential appraisals. You send an appraiser out there. They're probably going to look at some market comparable sales recently. They're going to look at the square footage of the home in the neighborhood and, put it all in a black box, and they come out with a number. Well, in commercial, there's basically three ways. There's the cost to reconstruct a similar building. There's the market approach, which is what you're familiar with, where they go out and look at comparable sales or look at the geography, type of property. So in commercial, you're going to look at other properties in that geography, not just Ohio, but central Ohio, maybe not even central Ohio, but other properties in Gahanna or other properties in Short North or whatever it might be. And not just other commercial properties, but other retail commercial properties or other apartment, complexes. So as specific as possible. And then they do something that's different than in residential, and that is they'll do an income capitalization approach. And this is what I want to spend a few minutes on. And if I go too deep into this, maybe it's way more than what you want, but someone might want to know. And so I'm going to take just like 5 minutes and walk through an example of what I mean by this. But this is where they're appraising a piece of commercial property based on the net operating income, the NOI. So that's a really good acronym to know when you're talking commercial real estate is NOI, net operating income. So Kristen, if we can go to the next slide. If you think of any basic operating company, any business, like a Chipotle, okay, their net operating income they would call it net operating profit. So you take the revenues that they bring in from selling all their burritos, you pay your employees, pay the light bill, pay the rent bill, whatever, and what's left is their net operating income before they pay interest on their loans and income taxes and all that. Okay, so that's net operating income. In the world of commercial real estate, we call it not operating profit, we call it net operating income. And so it would be the rental income coming in for a property minus the operating expenses for that property. Okay, so that may or may not be new. Is everybody okay with that definition, NOI? Okay, the other important term you want to know for commercial real estate is capitalization rate. They call it the cap rate. And the cap rate, as best I can simply explain it, is just they go out to comparable sales in the area, commercial properties that have sold recently, and the cap rate is a percentage. They take the net operating income of those properties and they divide it by the sales price. So for example, if a property sold for, if the net operating income was $100,000 per year and it sold for $1 million, then that says the NOI, or the cap rate rather, would be 10%. Simple math, okay? 100,000 NOI per year, sold for $1 million. What they're saying is the cap rate's 10%. So the appraiser of the property you're looking at is going to go out in the area. Commercial appraisers know the cap rate for different areas, but that's how it's determined, is from comparable properties that have been sold recently in that area. And if we can go to the next slide, then once we have that cap rate, then if we want to come up with a value for our property we're looking at, we just take the NOI of our property and we divide it by that cap rate. So again, if we have a property that has an NOI of 100,000 and the cap rate is 10%, we divide that in the value, we go, this property is worth $1 million. Okay, so that's the income capitalization approach. Let's go to the next slide. Well, actually, if we can pull up that example just real quick, Kristen. I think Kristen may have emailed this out, or she didn't. I just want to look at, and I've got 10:32. Are we good on time to take maybe 5 minutes on this, Kristen? Okay. So if you can make that bigger, and the other folks on the call, do you have a copy of this in front of you?
Mm-hmm.
Okay. So again, if this is too much detail, just kind of follow the logic here. But up top, so here's an office space, commercial office. There's 8 units in this building. And let's just say at the top, the rental cost for the tenant is $18 per square foot on an annual basis. And if each unit, I just made up some, it looks like they're about 15 wide by 50 deep. So each unit's 750 square feet. Multiply that by the $18 per square foot. So they pay $13,500 a year, each tenant would. And there's 8 tenants if it's all full. So when fully occupied, this would generate $108,000 of annual rental income for the owner of this property. Everybody good on that so far? Okay, so if you were to do the profit and loss for this property, you got the $108,000 in rental income. I listed some expenses there: property taxes, repairs, security, management fees, insurance. That totals 62. So your NOI is 46,000 for this property. Okay, and we're trying to figure out what the property is worth. So the appraiser would take that 46,000, and let's say that we know that the cap rate in this area is 8%. You take the 46,000, you divide it by 0.08, and you come up with the value of $575,000. Everybody good on the math so far? So that's the value.
Feel smarter.
What's that?
Feel smarter.
Yeah, doing all this math, it's like some people are getting, are cringing. Some people like this stuff. So that's how they come up with the value. The appraiser comes up and says, this is based on an income capitalization approach. It's worth 575. And then so let's say the loan was done 3 years ago, and now they've used this method to come up with that value. We take the current outstanding balance, which let's say is 400,000. And this creates the all-important loan to value ratio. We're comparing what the property is worth to how much they owe on it. And obviously, since it's loan balance in the numerator, value in the denominator, the lower this number, the better. We'd much rather have a 70% loan to value than an 80 or 85%. Most commercial lenders don't want to go above 80 or 85% on loan to value on commercial. You all know in the residential world, back at a bank I worked for back in 2007, they were doing 105, 110% loans on the value of people's homes. That did not work out well for that bank. And a 150-year-old bank called National City is no more because they were doing too much of that. So commercial lenders are a little more cautious. They like to stay under 80%. If it's owner occupied, sometimes they'll do 85, because owner occupied means it's a commercial space, but it's a company, and that company occupies the whole space. They've got their employees in there. So that's a little safer in that they're not relying on a bunch of tenants to renew the lease and make the payments.
Oh, I forgot I wasn't muted. I thought owner occupied meant that they lived in there.
Oh, that's okay.
It just means that they bought it, they had a loan on it, and they operate their business out of it.
Correct. Yep. So
not like.
Yeah. So So again, that's a terminology thing. So in the commercial world, owner occupied just means that the business that's making the payments on the loan is also the business that occupies 100% of the property. Sometimes they'll occupy 80%. They've got a little space they don't need. They'll rent it out to make a little bit of extra income. But when you get into having most of your income generated from your tenants, then you're relying on them and them renewing and them paying. And you have less control over that. You, as the owner of the building, have less control over that than you do than if it's your company. Now, your company could still go belly up and not make payments, but in theory, owner occupied is a little bit less risky. So sometimes they'll go up to a little higher loan to value. So maybe that example was too much math, but some people, when I do these things, they say, well, I get those concepts, but show me how it works. So there's kind of a, back of the napkin calculation of how that works. So if we can then go, I think we just got one or two more slides, Kristen, and I'll wrap up. But if we can go back. So we use this approach to get that value, in that case, 575,000. And then we compare it to the outstanding balance. And as they pay the loan down, the loan to value is going lower. And we like that. That means there's a little bit less risk. So one more, that's good. So that gives us, once we have the appraisal, it gives us that loan to value ratio. And there's the formula, it's the balance divided by the appraised value. The lower the ratio, the lower the risk. And we view that as, the underwriters view that as better collateral then. In other words, if there's a market adjustment and the value of the property goes down a little bit, if they've paid the loan way down, then we're safer, right? If it's a 50% loan to value, if they only owe 300,000 and the thing is appraised at 600, then if the value drops from 600 to 450, now we're still okay. We've only got 300,000 owed and there's still a good cushion there. You all know how that game works. And I already talked about these loan to value policies depending, so I got ahead of myself there on whether it's owner occupied or not. And I think that's the last slide, unless, yeah, it is. So I will stop there, having bombarded you with a lot of information, and try to field any questions that you have. Yes.
Can I go ahead?
Stacy.
Okay. So normally on a commercial purchase, how involved are other parties? Like an attorney I was under the impression that normally in a commercial purchase, an attorney would be really involved in the transaction. Is that the case or not always?
I would think so, more so than you're going to see in residential, because again, it's just a bigger dollar amount. There's other legal things that aren't going to come into play in the residential world. And I don't mean to demean, I'm doing residential lending. There's a lot of complexities and I'm pretty new at it and I'm overwhelmed at the complexity. So I'm not at all saying, hey, that's for simpletons, commercial is more complex, but commercial is more complex. There's just, zoning things, there's wetlands things, environmental things. I didn't even get into environmental. That's a whole nother piece of the commercial real estate world. And commercial construction is a whole other thing. So yeah, there's a lot involved, and almost always the lender, the borrower will probably have legal representation and the lender will have legal representation. Every bank I've worked for has a whole team of lawyers that do nothing but represent the bank in commercial real estate transactions.
Okay, my current purchase is she is an attorney, and so she's buying. It was an old optical office, optician or whatever, and they're going to rehab the office. But so she's purchasing it, and then she had a building inspection, and she's doing an environmental inspection tomorrow. I guess, does the lender have any preferences on what inspections are done in a commercial building, or would it be up to the agent to say, you should do a mold, you should do these specific inspections?
Well, my understanding is I know that there's some that are required that you just have to do. There's an environmental site assessment, an ESA. There's a phase 1 and a phase 2, and in some, I don't remember what all dictates whether you need a phase 2. The phase 2 is much more involved. And then in terms of inspection for things like mold, I don't know if that's part of that or not, but there are some things that are required. And if anyone's a lawyer, they have a lawyer representing them, they should know that the lender will insist upon it. The lender won't let the loan move forward until they've done those phase 1 and if needed a phase 2. That's not my field of expertise, but I know that there are things that are not only recommended, but they're mandated.
Okay.
By the
And that was going to be my other question, is as far as timelines. Obviously with residential, we're looking at 30 days. And, that's where I had to get Tom. I was like, I don't know what to put for inspection deadlines and those types of things. So we pushed them out a little bit longer. But I didn't know if the lender would get involved with that as well. So I'm glad to hear that there are certain things they would mandate. And that way, if I miss something, they're going to have the person do it. The lender really has not been in communication with me all that much. And I don't know if that's normal on a commercial transaction.
I'm always of the mindset, residential or commercial, that the more communication, the better. So I would think, it'd certainly be helpful if they're communicating and keeping everybody in the loop. Because there are, on commercial, there's just, I don't know if there's more steps, because there's a lot of steps in residential too, but there's more pitfalls along the way and complexities. And so, the more communication, the better. Again, my background isn't so much lending as it is behind the scenes on the credit and underwriting side. So I can't speak to that from a lot of personal experience, but certainly wouldn't hurt to, if they're not reaching out to you, to reach out and just ask to be kept in the loop. That wouldn't be inappropriate.
Okay. Thank you.
Sure.
Okay, I have a couple questions. Number one, you were talking a lot about collateral. So if it's a 70% loan to value, they've got 30% down cash. Let's just say it's $1 million building. They're $300,000 down. What would be additional collateral if, a small business owner wants to buy a $1 million building?
Probably nothing. The building would be the only thing they would probably take. I mentioned those other things just to give you a sense of, in the commercial banking world in general, sometimes it's equipment, sometimes it's inventory and accounts receivable based on what kind of company it is. If you have a company making a product, I worked for a bank that banked Honda manufacturing. So you've got automobiles and automobile parts and all that kind of stuff. But in commercial real estate, typically all they would take is just a first lien on the property itself.
Okay. And second question is with the cap rate. I've never really I've done very little commercial in 30 years, but the cap rate, is there a better or a worse cap rate to look for?
I used to ask the guys in the commercial real estate lending team there how they come up with that number. I told you basically it's based on comparable properties in the area, but it's one of those things that's like the secret black box. And if you talk to people that have been in the industry for a long time, they'll just kind of, they know what the cap rate is, this type of thing. So how they come up with it is probably more of an art than a science, but the lower, the better. And that if you're in an area with a 7% cap rate, remember you're dividing the appraised value by the cap rate. So if the cap rate's lower, that's going to create a higher value of the property. So in general, the lower the cap rate, the higher the appraised value is going to be. So if you have a higher cap rate, you get up 9, 10, 11, 9, 10, 11%, that's going to be not as good, so to speak, because it's going to drive the appraised value down. So lower is better for cap rate if you're looking for higher values.
Okay. Okay, good. And the last comment was just, in one of the classes I took at during the operating partner training was about commercial real estate. Should a Keller Williams owner of a Keller Williams franchise own their own office building? And it's strongly recommended, if you do, that you are only a 1/3 tenant, or or less. And so you're going to rely on not only you and your agents paying rent, but also your tenants to be helping out with the rent. So when we thought about actually buying a building back in 2006 at one of the other Keller Williams offices I'm involved in, and in Dublin, and we seriously thought about buying a building. It was just under 3 million, and it was 30,000 square feet, I think. And it needed a new parking lot and some other big ticket items. And we kept hearing the shift was coming, and we heeded and didn't buy it. And I thank God every day that I didn't buy that building.
Yeah. Well, that's interesting. That makes sense in the sense they say they wanted at least 2/3 to be tenants, because let's say you have an office with X number of realtors and the market crashes, whatever, and real estate business goes down. In that sense, it helps you to have other tenants. So you're not relying on Keller Williams having so much activity and needing all the space. The flip side of that is if you have two other tenants, each occupying 1/3, and they're in businesses that are also impacted negatively by the economy. So that's where you got to just be wise about who those businesses are, what industry they're in. Are they in a cyclical or counter-cyclical business, meaning some businesses, when the economy tanks, their businesses do better. They're counter-cyclical. Those might be good to have so that if the economy tanks and your office space needs are less, they're going to maybe need more office space. So those are all the kind of things you need to think about. And I don't claim to have perfect wisdom on that, but those are the things you want to think about if you're going to have tenants. You don't all want to go down at the same time. In other words, if the economy crashes like it did 12 years ago, it'd be nice to have some that are still going to be doing okay, at least theoretically.
Good point. Thank you.
Other questions? I know we're bumping up against time, but I've got time if you have more.
One question, and I don't know if this pertains to something that you do or understand, but I know that the Tuttle Mall is in foreclosure. How does that work when a commercial building goes into foreclosure? Can you even?
Well, yeah, I mean, that's obviously a huge property and probably ridiculously expensive. And the question then is who can buy it? I mean, if the bank forecloses or the bank group forecloses, it's like I've been in situations where you have, it's certainly a special purpose type of real estate. Like that's not going to be office space. We used to do loans at one of the banks I worked for on some of these really huge churches in town. And when you foreclose on one of those, which did happen a couple times, who's going to come in? That's a very special purpose real estate. So yeah, I don't know. That's a big mess.
Is it like trickle down, like the tenants are not able to pay the people that are running the mall, and so the mall can't pay its mortgage, and so it's being foreclosed on?
Right. It's probably, I don't know. I don't know the situation up there. It may very well be somewhat related to COVID. You know, people are just not out. They're afraid to go out in public. They're afraid to interact with other people. So most retail shops, restaurants or retail shopping like that are obviously hugely negatively impacted. You know, I could give opinions on whether the governor's doing the right thing with all these shutdowns and restrictions. It seems like it's overreach from my perspective, but that's just Andy Keusal. But the fact that is what's happened, boy, if you own those businesses and no one's coming into your store, what can you do? That's largely out of your control.
Yeah.
So you're right. They don't have revenue coming in from people shopping, so they don't have money to pay the rent to the owner of the mall. And you're right. It's a domino effect, and that's happening all over the country, obviously. And so a lot of banks I'm seeing, they're having these webinars and having meetings of what do we do? They want to offer their borrowers some kind of, they'll let them delay their payments, offer some kind of forbearance for a time, but you can't do that forever because banks can only be so patient. And so it's a really unfortunate thing that a lot of entrepreneurs and business owners are doing everything they could, and something completely beyond their control that was arguably unnecessary really ended up negatively impacting them and negatively impacting the owners of the real estate they were paying rent to.
I'm just wondering, like, if it does actually go through foreclosure, like, would they would they shut the whole thing down? I mean, even that place is so busy. I see so many people in there. Like, why would you shut it down? I don't know. This is maybe a conversation outside of
Yeah,
here.
no, it's a good, I mean, I don't know the shopping mall world. I remember, if you all remember, and you've been around long enough, back when City Center Mall, back in 2000, that place was booming. I used to work downtown. I'd walk around there at lunch every day, and there's thousands of people walking around. And then slowly over years, as Tuttle and Easton opened up, people kept saying City Center is really dying off. I thought that could never happen. And then, the rest of the story had died off. They tore the whole thing down. It was unbelievable. So, again, people that own shopping malls, they, they're supposed to know about this stuff and foresee things and be hedging their risk. But I don't know who could have hedged a risk that the government would tell people not to go out in public for a year. That's a difficult thing to see coming.
I've heard rumors that it will go into foreclosure, and there are some people looking at it to turn it into residential apartments and office suites.
Oh,
I was just thinking that would that not be a better use of value for that, that piece of land, right? Or that area.
Depending on the price that somebody can buy it for, absolutely. I think that'd be better served as apartment housing.
What's that term when the best use, the highest and best use of that land might actually just be living space?
interesting. Yeah. I hadn't heard about that, but interesting to see what'll happen.
Anybody else have any questions?
Okay.
Okay.
We'll give the opportunity to jump in, and Kristen, you're welcome to share my contact info if you have it. If anyone's got purchase deals and you're looking for help financing, I'd appreciate the opportunity to work on it. And thanks for your time. You're welcome to reach out later if you have other questions on this topic too.
Send your information, Andy, to everybody that was on this call. I have the names written down.
Okay, very good.
Thanks for coming, you guys. I'll see you in a few minutes on our office meeting.
All right, thank you all.
Bye, Andy. Thank you.